Well, there's been a lot of talk lately about whether this latest pullback in gold and silver means the move is running out of steam. So in this video, we're going to separate the signal from the static, and you are going to walk away feeling a whole lot clearer about what is actually driving this market. It is Monday, April 20th in New York, so go ahead and tell me in the comments what day and date you're watching from. And very quickly, if you value the way I break this stuff down, support the channel by subscribing and commenting John A.G. Best. That simple little comment helps more than you think. Now, I was speaking with metals people recently, and let me tell you, the conversations kept coming back to the same pressure points over and over again. Gulf shipping, energy costs, mining margins, silver tightness, and then the bigger question hanging over all of it. What happens to gold and silver if cash stops paying people enough to sit still? That first piece matters more than people realize, because the market tried to celebrate a calmer geopolitical headline, and I think it got ahead of itself. We just saw crude rip higher again as fears around the Strait of Hormuz came back into the picture, and that is the kind of move that can reprice inflation expectations in a hurry. When oil starts jumping around like that, it doesn't stay trapped in one neat little sector. It leaks into transport, refining, insurance, food, manufacturing, sentiment, and eventually into the bond market itself. So when somebody says, "Why are metals acting like this?" one answer is very simple. Because energy is one of the fastest ways to remind the market that inflation is never as dead as central planners want it to look. Then you get the second layer, mining. And this is where people oversimplify the story. They think higher metals automatically means higher profits for every miner, but that is not always how this works. A miner is a business with fuel costs, labor costs, processing costs, financing costs, permitting issues, and operational surprises. So when energy gets jumpy, margins can get squeezed even inside a bullish metals environment. That is one reason bullion can sometimes tell a cleaner truth than the equities tied to it. And then, of course, the conversation turns to silver, because silver has this nasty habit of refusing to behave the way the doubters want it to. It gets hit, it wobbles, it pulls back, and then before people can finish writing the obituary, it starts finding a bid again. That is usually a sign that there is something stronger underneath the market than a simple momentum trade. Now, some people want to explain that with a dramatic secret buyer story. You've heard the speculation. Maybe official stockpiling is happening. Maybe strategic metal is being gathered quietly. Maybe strange refinery congestion and unusual transaction chatter are clues that something bigger is going on behind the curtain. Let me give you the skeptical version. Strange things happen in stressed commodity markets all the time without requiring a hidden hand. Backlogs can come from processing bottlenecks. Weird realized pricing can come from hedging, contract timing, byproduct accounting, or one-off commercial arrangements. So I'm not saying official demand could never be part of the picture. I am saying you do not need to marry the most cinematic explanation when the broader monetary setup is already bullish enough on its own. And that broader setup is really the story here. The real driver, in my opinion, is not one rumor, one weekend headline, one speech, one tanker, or one silver anecdote. The real driver is what happens when the return people get on cash and safe paper starts feeling smaller than the inflation they experience in the real world. That is the moment when the psychology changes. That is the moment when holding dollars feels less like safety and more like silent erosion. Now, I want to slow down here, because this is where the entire bull case lives or dies. If inflation is running hotter than the after-inflation return you can get from the safest parts of the financial system, then cash is not really protecting you. It is preserving the appearance of stability while your purchasing power keeps leaking out through the floorboards. People often miss that because they are trained to think in nominal terms. They see a positive rate and assume that means progress. But if your real-world cost of living is climbing faster than your supposedly safe return, you are not getting ahead. You are just losing politely. And when that happens, hard assets begin to make more sense. Not because they are magical, not because they send you a coupon, but because they are outside the direct machinery of currency creation. Gold and silver become attractive when the promise attached to paper starts feeling less solid than advertised. We have seen versions of this before. We saw it when the old monetary order cracked in the 1970s and hard assets repriced violently. We saw it again after the early century growth scare when rates were crushed, policy got loose, and money started flowing back into things that could not be created by decree. The details change, the mechanism rhymes, and now look at the present setup. Fresh inflation data in the United States came in hot for March, with the headline index jumping sharply on the month and running above 3% over the year. At the same time, long-term real Treasury rates are still positive, yes, but only in the mid-2% area, which is not some wildly generous reward for holding paper in a world of debt stress, policy uncertainty, and volatile energy. That is not the kind of real return that makes hard assets automatically irrelevant. Meanwhile, the federal debt is now basically sitting around the $39 trillion mark. That is an enormous burden to carry in a world where policymakers also want growth, stable markets, functioning housing, manageable refinancing, calm banks, and happy voters. These things pull against each other. You cannot have giant debt, politically sensitive borrowing costs, and permanently restrictive real rates forever without eventually breaking something important. That is the math people keep trying to avoid. Because once enough debt exists, the system becomes less tolerant of honest interest rates. It can talk tough for a while, it can posture, it can pretend discipline is back. But the larger the debt mountain gets, the more pressure there is to suppress the real burden of carrying it. That usually means inflation running a little warmer, money a little softer, policy a little friendlier, and savers a little poorer. And that is precisely the kind of environment where gold does not need permission to matter. Now let's add another layer here because this is important. The official sector has not exactly been treating gold like some barbarous relic. Quite the opposite. Gold demand globally hit record levels last year when you include over-the-counter activity, and central banks kept buying even after prices made repeated all-time highs. That tells you something. When institutions that think in terms of reserves, settlement trust, and long-cycle stability continue adding gold at elevated prices, they are not doing that for decoration. They are doing it because gold still solves a problem that paper claims do not fully solve. And that problem became a lot more obvious in recent years. Once reserve managers around the world saw that sovereign assets could be frozen or impaired by politics, the appeal of neutral reserve assets changed. Gold started looking less like an old tradition and more like strategic monetary insurance. That trend has not gone away. If anything, it has deepened. Silver, of course, sits in a different lane, but that is exactly why it gets so interesting. It has monetary sensitivity, yes, but it also has industrial demand. And that means its character can change fast when supply gets tight and investment demand shows up at the same time. According to recent industry reporting, the silver market is still expected to post another annual deficit, which would stretch this imbalance to roughly half a dozen consecutive years. That does not guarantee a straight line higher, but it does mean the market is not exactly drowning in abundance. And when a market is not drowning in abundance, surprises matter more. That is why I keep telling people not to underestimate silver just because it can be messy. Yes, silver is more volatile. Yes, it shakes people out. Yes, it can underperform gold for stretches and then make up the difference in a burst that leaves everybody breathless. That is the nature of it. It is a more nervous metal. But nervous does not mean weak. Sometimes nervous just means compressed. Now, let me challenge one more lazy assumption. A lot of people still try to explain every metal's move with whatever war or political headline is happening that week. And sure, those things can absolutely matter in the short run. They can move crude. They can shake currencies. They can create fear. They can nudge flows. But over the longer run, metals do not build true secular moves on headlines alone. They build those moves on deeper conditions: debt, liquidity, real returns, trust in paper, trust in institutions. Trust in the future purchasing power of currency itself. That is why I keep coming back to real rates. When real rates are meaningfully positive and trusted, gold usually has a harder time stealing the spotlight. When real rates get thin, uncertain, or negative, the case for holding metal gets easier for more people to understand. Not all at once, not in a straight line, but steadily. And I think we are much closer to that second world than the market likes to admit. Add in the fact that the Federal Reserve's balance sheet is still gigantic by any historical standard, and entitlement pressure is marching toward the front door of the next decade, and you start to see why the old, just earn a safe return and relax model does not feel as durable as it once did. The cushion is thinner than people think, and everybody knows it. Even the government's own trustees continue to project that the main old age Social Security Trust Fund would hit depletion in the early part of the next decade. Think about what that means. More fiscal pressure, more political pressure, more incentives to borrow, monetize, reflate, and soften the system rather than allow a genuinely hard reset. Do you really think all of that ends with savers being handed deeply rewarding real returns for the next 10 years? I don't. I think the bias remains toward financial repression, whether the language gets dressed up nicely or not. And if that is true, then this pullback in metals should not automatically be read as the end of the story. It may just be one of those uncomfortable pauses that strong trends use to test conviction. Bull markets do not feel bullish every day. In fact, they usually feel confusing precisely when the next leg is being built. That is especially true in a market like this, where gold has reserve demand under it, silver has tighter physical fundamentals than many expected, energy can still reignite inflation scares, debt keeps expanding, and policymakers are boxed in by competing priorities. That is not a recipe for perfect calm. That is a recipe for periodic disorder with a bullish monetary undertone. If you're successful, share your success story in the comments so others can stay motivated. And let me leave you with this. Do not anchor your entire thesis to one dramatic silver rumor. Do not anchor it to one refinery bottleneck. Do not anchor it to one politician's trade disclosure or one quarter's strange accounting outcome. Those things may be interesting. They may even turn out to matter around the edges. But the foundation is bigger than that. The foundation is that the world keeps producing more debt than it can comfortably carry, more promises than it can easily fund, and more reasons for policymakers to favor easier money over truly honest money. In that world, gold and silver do not need perfection. They just need the paper system to keep behaving the way heavily indebted paper systems usually behave. That is why I do not think the bull market is over. I think most people are still staring at the fireworks and missing the fuel tank. So keep your eyes on inflation. Keep your eyes on real yields. Keep your eyes on debt, on energy, on reserve behavior, and on whether safe paper is actually delivering a safe real return after all the noise clears. Because if it isn't, then gold and silver are not done teaching this market a lesson. One more thing, because I do not want this to sound abstract. Last year, total gold demand, including over-the-counter buying, pushed above the 5,000-ton level for the first time, and exchange-traded funds saw one of their strongest years on record. That is a big deal. It tells you this move has not been living on one weak leg. It has had official buying, investor buying, and safe haven buying all taking turns supporting it. A market that can keep attracting capital after repeated record highs is usually not acting like a tired final stage blow-off. It is acting like a market that still has deeper sponsorship underneath it. And if oil keeps lurching around while inflation stays sticky, that sponsorship can matter a lot. Because policymakers then face the worst kind of trade-off. Ease too quickly, and you feed the inflation problem. Stay too tight for too long, and you stress the debt structure, the banks, the housing channel, and the broader economy. That is not an easy escape hatch. That is a narrowing hallway. And when confidence gets rationed, capital starts hunting for anchors. Some money hides in cash for a while. Some sits in short paper. But a meaningful slice eventually walks back toward monetary metals, because trust is harder to print than currency today. So when people ask me whether this is the moment to get discouraged, my answer is no. This is the moment to get disciplined. Not emotional, not euphoric. Disciplined. Understand what you own, understand why you own it, and understand that metals do not need a perfect world to work. In many cases, they work because the world refuses to stay perfect. That's all I wanted to lay out for you today. If this helped, subscribe, leave a like, and comment John A.G. Best so I know you want more breakdowns like this. Take care of yourselves, take care of each other, and remember this is for education and discussion only. I'm sharing how I see the landscape, not giving you personal financial advice, so always do your own homework before making a move.